Hello everybody, in today's video we are going to do the chapter 17 of ACCA Business and Technology F1, Fraud, Fraudulent Behavior and their prevention in business. So before watching this video, if you would like to study the other chapters or the chapters I've covered before, the link of the playlist is given in the description box below. Make sure that you check them out and then you can come back to this video. And in case you want to know the solutions of the exam kit, even that playlist is given in the description box below. So in this chapter we'll be learning about the various types of frauds and what are fraudulent behavior. So to begin with, what is the meaning of fraud? Fraud is an intentional act involving the use of deception to obtain an unjust or illegal advantage, essentially theft by deception. Fraud is a criminal offense punishable by a fine or imprisonment. So you know what fraud is. Now, what is error? Error means it is a mistake which has not been done intentionally. Errors are something which happen by mistake without knowing. So errors refer to unintentional mistakes. Error is an inevitable part of human nature, so systems of internal checks are essential in order to prevent or detect any possible errors. Now, what is irregularity? Irregularity is something which we are doing deliberately, and irregularity is something contrary to a particular rule or standard. Misstatement. So misstatement is something which is stated wrongly. Misstatement can arise due to fraud, irregularity or error. So misstatement means that we are putting wrong information, so that can be either intentionally or unintentionally. Now let's find out the difference between fraud, error, irregularity and misstatement. What is fraud? Fraud should be contrasted with error. So fraud is something which we do intentionally, error is something which is unintentional in nature. While fraud is an intentional act, error is unintentional. For example, if a purchase ledger clerk deliberately enters a false invoice from a friend into the purchase ledger, hoping that it will be paid so that the clerk and the friend can split the proceeds, this is a fraud. However, if the clerk accidentally enters an invoice twice into the ledger, so that is an example of error. Now let's come to irregularity. Irregularity would occur if a petty cash system designed to limit individual vouchers to less than $50 but allowed a single voucher of 70 to be processed. So that is what irregularity is. An example of misstatement may be when a balance sheet shows a building at cost of $1 million, whereas the actual cost was $1.3 million. This misstatement could have been purposeful fraud or an accidental error. As far as the financial statements are concerned, fraud comprises both the use of deception to obtain an unjust or illegal financial advantage and intentional misrepresentations affecting the financial statements. It is ultimately up to the courts to decide in each instance whether fraud has occurred. So, deliberate falsification of documents, deliberate ignoring of errors, deliberating suppression of relevant information. Now, let's come back to the next topic, that is who carries out the fraud. Who are the people who do the frauds? So, know that fraud may be carried out by management, employees, or third parties. Managers may deliberately select inappropriate accounting policies. So since the manager has so much information about the organization, they can deliberately choose the policies which will benefit them. Employees may steal the proceeds of cash sales and omit to enter the sales into the accounting records. That's self-explanatory. And what can the third party do? Third party can send in bogus invoices to the company. So if the company doesn't check the invoice properly, then company will just pay it to them. So that is also another way of how the third party can fraud us. Now let's come to the test your understanding 1. A rogue trader has sent to your company a bogus invoice for advertising in a non-existent publication. The rogue spoke to a purchase ledger clerk at your company and convinced her that the company had placed several previous advertisements in the publication in the past, so that this repeat advertisement was genuine. The clerk was innocently fooled into passing the invoice for payment. So, has rogue committed a fraud, or has the clerk committed a fraud? Will the rogue be paid? Now, in this, see, rogue, the non-existent publication, they have deliberately committed the fraud. They are intentionally trying to fool us. And was it the girl's fault? Who was the girl? Where's her name again? Yeah. Has the clerk committed the fault? See, she has no dishonest intent. It's just that she has made a mistake by believing the rogue, but then it's not like she wanted to purposely do that, right? Will the rogue be paid? It depends on the other controls in force. If the company has no other controls over payment apart from clerk's authorization, then the rogue will be paid. But that's not really the case. You always have at least two people doing the same work, or you need authorization from many people before the payment is being made. So, if that is the case, then the rogue will not be paid. The prerequisites of fraud. So there are three prerequisites of fraud. What are they? The first one is dishonesty. So dishonesty relates to the lack of integrity or honesty. An honest employee will be unlikely to commit a fraud. So dishonesty means a person who is not honest and they keep lying and they do not have a sense of integrity in them. Opportunity. The individual must have the opportunity or opening for a fraud to be committed. These opportunities will often be created due to weak internal controls. So, an individual will be able to commit a fraud only when they see that an opportunity like that is being created. So, the individual must have the opportunity for a fraud to be committed. These opportunities will be created. When is the system? When does this such an opportunity even get created? Such an opportunity gets created if the company has weak internal controls, right? Motivation. So the individual must feel that the rewards that can be earned by the fraud will outweigh the potential costs if they are caught. So another prerequisite is that the person is being very motivated by the fraud. They feel like the reward we will get is more than how much we have to suffer if we get caught. So what are the three prerequisites of fraud? Dishonesty, opportunity, and motivation. All three are usually required. For example, an honest employee is unlikely to commit the fraud even if the opportunity and the motive is being there. So, what are the factors that might indicate an increased risk of fraud and error? Okay. The first thing is management domination by one person or a small group of people. If only one person is managing the entire organization, or if only a small group of people is, kind of taking care of the organization, then it is very easy for them to commit the fraud since there are very less people and they all can keep a secret and share the profits or illegal profits, I mean. So, dominant individuals often find it easy to circumvent controls and procedures. Unnecessarily complex corporate structure. So, the corporate structures can be just easy and simple. If you unnecessarily have a very complex structure, then that will also lead to some sort of fraud. This makes it harder to trace transactions, meaning it is easier for employees to hide fraud. Poor staff morale. So if the staff dislike the company they work for, it may give them additional motivation to perpetuate the funds, right? Personnel who do not take leave or holidays. Okay, why do people not take leave or holidays, and how will that be related to committing fraud? If I am committing a fraud in a company, let's say I am the one who is maintaining the purchase ledger every day and I am committing some fraud and omitting the money. If I take a leave, then if I take a holiday, then someone else will be doing my work on the day I take a leave. So if they're doing my work and if they get to know that I have been committing fraud, then that will land me into a trouble. So that is why we are saying that personnel who do not take leave or holidays, who do not take leave or holidays, they might be committing some sort of a fraud. Lavish lifestyles of employees. So there's nothing wrong in having a lavish lifestyle, but then if some employee had been, let's say, poor, and now they are extremely rich, like extremely rich, and something which is, kind of strange and not believable. Such a situation might also mean that a fraud has been committed. Inadequate segregation of duties. When the duties are segregated, like if you need to purchase ledger work, if it's segregated by two people, one person does it, one person checks it, or something like that, then in such a situation it will be good. But then if only one person is doing the entire work, they know that nobody else is going to check, so they might just commit the fraud. Lack of monitoring of control systems. So for controls to be effective, they need to be monitored on a regular basis. Unusual transactions in cash or direct to numbered bank accounts. So something which is unusual would like reflect the fact that fraud is being committed. Payments for services disproportionate to effort may also be an indication of fraudulent activities. If you know that payments are made which are not proportionate to the effort. If management has established a strong system of internal control, remember the five components of internal control we had studied in the previous chapter, then the potential of fraud is to be reduced. Okay, what is the role of audit in preventing and detecting fraud? It is up to the directors to decide what internal audit should do. But normally, where there is an effective internal audit department, the internal auditors will be given the responsibility to test the internal control system and to recommend improvements. So, what the internal audit system is expected to do is that they need to check the internal controls and give advices and suggestions. The better the control system, the less likely it is that the fraud will be attempted or will be succeeded if it is attempted. The directors may also ask the internal auditors to carry out a specific investigation into situations where fraud has been discovered to learn lessons for the future. See, when you learn about a certain fraud which has already occurred, you can make sure that it does not happen in the future. The role of the audit committee in preventing and detecting fraud. So, the precise role of the audit committee will vary from company to company, but the UK Corporate Governance Code recommends that the audit committee should keep under review the company's internal control and risk management systems. They should implement improvements where weaknesses are found in order to reduce the profitability of fraud being carried out. The audit committee should also ensure that there are arrangements in place whereby employees of the company can, in confidence, raise concerns about possible improprieties that they are concerned about whistleblowing arrangements. Employees may wish to report their suspicions about the behavior of fellow employees through this channel of communication to those in authority. So there must be a situation like the whistleblowing arrangements. In such a situation, people working in a company, if they are aware of the fact that somebody else is committing a fraud, then they can safely come and inform that to the management by staying anonymous for the safety reasons. Now let's see what are the examples of fraud in a business organization. Forewarned is forearmed, so the saying goes. By studying examples of fraud seen previously in businesses, you should be better able to assess the risk that such frauds may occur in your business, enabling you to respond properly to the threat. Frauds can be carried out by managers, employees, or third parties of the organization. Now, let's see what are the examples of frauds which are done by the management of the organization. So, financial statements. So, there can be a financial statement fraud, this can be done by the management. For example, by window dressing or by cooking the books. By doing this, it can show a better picture to the shareholders so that they are happy. Misappropriation of assets, that is when if the value of the asset is 10,000, you are showing the value to be 20,000, something like that. False insurance claims, when something has not been damaged, when our computer is not being damaged, but because we want the insurance money, we are making false insurance claims. Using the company's assets for personal use. There is a printer in my company or in my office. I take that home and keep it with me. So that is also a kind of fraud because that's not your personal printer. That is something which belongs to the organization. What are the frauds which are done by the employees? First thing is the sales ledger fraud. Teaming and lading, stealing cash, sales and checks received. So in sales ledger frauds, we be getting the checks or we'll be getting the cash. And there is one thing which is known as teaming and lading. Teaming and lading means that whenever you get cash, sales or the checks, you keep some of it with yourself and you do not show it in the books. That is known as teaming and lading. Purchase ledger fraud, which is the opposite of the sales ledger fraud. Skimming schemes, payroll fraud. All these are also done by the employees. Now let's come to the frauds which are done by the third parties. So what can a third party do? It can send bogus invoices to the company. It can send false billing. There can be a false billing fraud, bank account fraud, advance fee fraud, and Ponzi schemes. Now let's come to the frauds which were listed above and we can discuss them briefly. So what was the misappropriation of assets? Although all employees of a company may steal assets to a minor degree, like taking pads of paper, taking some stationery home with us, management are able to conceal more major thefts by amending the accounting records. For example, they may steal physical assets, example inventory, or non-current assets, and adjust the accounts to show that these items were written off. So I can take a computer home and then I can just show it that it had been depreciation has been done and it is written off or it got damaged. I can lie like that and take that computer to my home. They may sell intellectual property, example plans of a new product, to a competitor for cash. So our competitors, they would like to know our future plans. So if they ask me to tell me our plan, in return they'll be giving me a lot of money. So that is also a way in which fraud can be occurred. Such frauds are usually hard to detect because the accounting records look to be in order. Now let's come to what false insurance claim is. A manager may steal a high value asset like a notebook computer and claim that it was stolen from him while on the company business. The company then lodges an insurance claim to remedy its loss. The insurance company is defrauded. Using the company's assets for personal use. So there are some instances are minor, like kind of sending our personal emails from the company computers or anything like that. But then the management are in a position to take the matters further. Why? So see, small things are excludable, but what about the big things? Like management can use the company's assets as a collateral for a personal loan. They can say that this belongs to me, even though that belongs to the office, and then take a loan. What are the sales ledger frauds? So there are several possibilities. Stealing receipts from debtors, example checks received in the post, and then writing off the sales ledger balance as a bad debt. Pocketing the proceeds of cash sales and never entering them into the accounting records. Teaming and layering frauds, in which the receipts from one debtor are pocketed by the fraudster, with this sales ledger balance being cleared by a subsequent receipt from another debtor. So, what is teaming and lading? Teaming and lading means that a debtor did not pay the money. Next time he came and he paid the money. But I didn't write in the records that he paid the money. I kept that money with myself. After that, another debtor came to return his money. Instead of filling in his record, I filled it in this record and showed that this debtor still didn't pay. All that behavior and doing this is known as teaming and layering. Now we come to what purchase ledger frauds are. A dummy purchase invoice can be entered into the purchase records. So we know what a purchase ledger fraud is. Moving on to skimming schemes. So what are skimming schemes? In a skimming scheme, the fraudster diverts small amounts from a large number of transactions, believing that no one will bother to investigate the small differences individually, although in aggregate they can total to a worthwhile sum. So, what is skimming schemes? Skimming schemes means that from every transaction you're just stealing a little money. That is something which is known as a skimming scheme. Payroll fraud. A typical example is to add a bogus employee to the payroll and pay their monthly salary into a bank account set up for the purpose by the fraudster. So, payroll fraud means that you are creating a fake name or a fake employee in the records and you're putting your bank account there, and salary for them is being paid on that bank account and it reaches to you. False billing fraud. What is a false billing fraud? This has been described earlier. Typically, a fraudster will send a bogus invoice to a company claiming that in respect to the company's inclusion to in a non-existent state, etc. So, like we saw in the tester understanding that the magazine has sent its invoice, wherein the magazine actually did not exist. So, we just saw what false billing fraud was, that when a company sends a false, bogus report. Now we come to bank account fraud. So, what is a bank account fraud? Some companies print their bank account details on their invoices, inviting debtors to pay money directly into the account. Alternatively, they may pay their bills by checks that show both the bank account numbers and what the required signature looks like. Unfortunately, this gives fraudsters the information they need. For example, to set up standing orders and direct debits out of the account into a bank account under their control. This situation is avoided by designating the account to deposit only, so that no one can set up a standing order, etc. Now we come to advance fee fraud. So, advance fee fraud is a confidence trick where a company is invited to pay a modest fee upfront in the promise of being paid a large amount in the future. The typical form in an email from Nigeria claiming that they want a transfer of large sum of money out of the country but need some money immediately to pay the necessary fees. Of course, if any fees are paid, the promised large number sum never materializes. Such emails have become so common they are known as 419 frauds after the section of Nigerian Criminal Code that they violate. Indeed, many companies now routinely filter out all the emails from Nigeria in their anti-spam settings, which has upset legitimate Nigerian business. Since the Nigerian email became so notorious, new variations in the large have been developed, such as being told that you have won a large sum in the lottery or anything like that. So, you all must have also been receiving some sort of emails like you have won a lottery or anything, and when you click on the link, you are taken to a site which can probably hack your bank account. Now let's come to what Ponzi pyramid schemes are. So I'll first explain what Ponzi pyramid scheme is. It's like I am an agent and I have a business where I ask people to invest the money. So I tell them that if you give me $5 today, after 10 years I will after 10 days I will return to you $10 through investing it somewhere. So how does this work? So person A came and gave me $5, and I told them that I'll give them $10 in the end of 10 days. Person B also came. They also said even I want. Person B also gave me $5. After a while, person C came and they also said I will give you $5. So now what the agent does? The agent has $5 which A already gave them, and they also have the $5 which B and C also gave them. So agent gives away the $10 of A by paying this and this which they already have. According to A, they might feel like they have actually doubled the returns. However, it was just that he collected money from various people and he gave it to you. Now, next time, if somebody else gives $5 again, he will give it back to B. So, by doing that, A and B will think that actually this is true. So, they are going to spread this word across everywhere so that more and more people come to invest with them. So, that is what is known as a Ponzi pyramid scheme. A Ponzi scheme is a fraudulent investment offer that involves paying abnormally high returns to early investors out of the new money paid in by subsequent investors. So after a while, what happens is that the following people who invest, they won't be getting the money. A more recent example of a Ponzi scheme was that perpetrated by Bernie Madoff, which is thought to be the largest financial fraud in the history of the US. Okay, now we know what teaming and lading was. It was also kind of related to the Ponzi scheme, but there the debtors are paid off. Teaming and lading is a juggling fraud, normally on the sales ledger, whereby the receipt of later debtors are allocated to pay off earlier debtors. Okay? As long as the organization regularly issues invoices for similar amounts and the fraudster takes no holidays to allow someone else to do the work and stuff like that. Moving on, what are the methods to discourage teaming and lading? So how can you discourage teaming and lading from happening? By rotating duties within the accounts department. So if you keep rotating the duties and if various people keep doing the work, then no one person is not the in charge of the thing throughout. So this will reduce the frauds. Insisting that everyone takes their annual holidays. So we had discussed the holidays part earlier. So we need to insist people on taking the holidays so that such a situation can be avoided. Sending regular statements to debtors. So we can regularly keep sending the statements if a debtor has paid or not paid. So then you know how that will help. Internal audit could carry out a circulation of debtors asking them to confirm the balances that they are recorded as owing to the company. Employing honest employees in the first place by checking the references given by job applicants is something you need to look at. Teaming and lading frauds cannot be carried out within the purchase ledger systems. So that is false. Even though teaming and lading is something which you see more on the sales ledger side, it can also happen on the purchase ledger side. Okay, now you come to fraudulent financial reporting. So what is a fraudulent financial reporting? Fraudulent financial reporting involves intentional misstatements, including omissions of amounts or disclosures in the financial statements in order to deceive financial statement users. So fraudulent financial reporting is intentionally making misstatements. What are the examples of fraudulent financial reporting? So the examples of fraudulent financial reporting are recording fictitious entries in the accounting records, particularly those close to accounting year end. What is next? Inappropriately adjusting assumptions or judgments used to estimate account balances. Inappropriately adjusting the assumptions or judgments, right? Omitting, advancing, or delaying the recognition in the financial statements. So when you delay writing something, when you delay updating it, and when you do things like that, that comes under fraudulent financial reporting. Concealing facts that could affect the amount recorded in the financial statements, which means concealing facts means you are hiding things. Altering records related to significant and unusual transactions. Okay. In daily language, such schemes can be referred to as cooking the books, creative accounting, earnings management. So, all these are known as something. So, we have even learned about another term which was known as window dressing. So, window dressing, cooking the books, and various other names have been given. Earnings management. So, these are the names which are given to the these kind of accounting, creative accounting. So, don't think that these are some good things. This is something which we are doing to fool the stakeholders. All these schemes may or may not comply with the letter of standard accounting rules, but they are usually contrary to the spirit of these rules. Ultimately, it is up to the courts to decide whether a particular scheme is fraudulent, but hopefully, the external auditors will have persuaded the directors of a company against such fraudulent scheme. Okay, now let's see the examples of creative accounting. So, what are the examples that a creative accounting has? Window dressing, delaying or accelerating a company's expenses, inaccurate revaluation of company's assets, manipulation of revenue recognition, off balance sheet accounting. So, what is window dressing? We know that a window dressing involves a misrepresentation of information, such as entering into of transactions before the year end that are often reversed out after the year end. The substance of which primarily is, it just makes the accounting statement look good. You can read the example by yourself. Now, let's see what is delaying or accelerating a company's expense mean. So, when you show an expense as an asset on the balance sheet rather than writing it off immediately against profits, is a quick way to improve your reported profits. So, this is contrary to acceptable accounting practices. When you have an expense, you need to write the expense off from the profit, right? Instead, if you show it on the asset side of the balance sheet, that is going to increase your profit, which will not show you the true or fair picture of the actual status of your company. So, accelerating a company's expenses may appear to be a strange objective. However, if a new bonus scheme is being introduced that will pay you a bonus if next year's profits are high, so you might be tempted to charge as many as expenses as you can to this year's. So, we do that this year so that next year the profit is high. What is manipulation of revenue recognition? If a company is engaged on a long term contract, they are supposed to recognize the revenues from the contract on a reasonable basis as the contract is fulfilled. It would be fraudulent to recognize all the revenue in the first year of the contract and none in the subsequent years. A similar problem arises when sales are recorded as soon as the goods ordered by the customers rather than when they are shipped to the customer. This practice has been tried by several internet retail sites, but again is contrary to the acceptable accounting practice. So, revenue recognition. Before receiving the revenue, you already write it in your books that you have received the revenue. That is something which is not really acceptable in nature. Now, let's come to what off balance sheet accounting is. So, what is off balance sheet accounting? A balance sheet is supposed to include all the assets and liabilities of the organization. Off balance sheet accounting is the deliberate exclusion of certain assets and liabilities from the published balance sheet, meaning that shareholders are misled about the organization's financial obligation. One example is a short term lease. If you lease a building for, let's say, 2 years, then under current accounting practices, you do not have to show the asset or the related obligation to pay on the balance sheet. You have to use the asset and you have a contractual obligation to pay the rentals, but neither the asset nor the liability are shown on the balance sheet. Now we come to the question. Suggest 4 reasons. So you know that if you have a bonus, then if you get a commission for higher profit, then you show that, or if you want the shareholders to be happy, then you do that. There are many various reasons. I think you can do it by yourself. Now we come to what money laundering is. So money laundering is the exchange of dirty money and assets that have been criminally obtained for clean money and assets that have no clear link to criminal activity. So obtaining dirty money is something which is known as money laundering. You must have definitely seen money laundering in various movies as well. So let's first read what money laundering is. While the term money is used, in reality, this can refer to any criminally obtained property, including cash, including securities, and tangible assets. Typical money laundering legislation recognizes three main offenses related to money laundering. So, there are three main offenses relating to money laundering. So, the first one is laundering. So, what is laundering? This may involve acquiring, using, or possessing criminal property, handling or being involved with criminal activity, investing the proceeds of a criminal activity, or transferring the criminal activity. In the UK, it carries a maximum of 14-year prison sentence along with fines. So, what is laundering? Laundering is something with which you begin with, which means you are involved in such a situation. You are involved in acquiring such a thing. You are involved in investing the proceeds from, getting it in a very unethical manner. And then, if you do that in the UK, then you might go to the jail for 14 years just for laundering. Now, you have the second point, which is the failure to report. Failing to disclose proof or suspicion of money laundering can carry a maximum of 5-year prison term along with fines. If I am working in a company and I know that my colleague is doing money laundering, and if I do not inform that to the authorities, even though I knew it, if I do not report it to the authorities, I might as well go to the jail for 5 years. Tipping off. Disclosure of information which may prejudice a money laundering investigation. Disclosure of information which may prejudice a money laundering investigation carries a maximum of 5-year prison term. So tipping off, if whoever is investigating, if you kind of tip them, or if you tell them some information which is prejudice in nature, and that's because of you, if the investigation process is gone, haywire, in such a situation also you can go to the jail for 5 years. So money laundering itself is in 3 parts. So earlier what we saw was the legislation that recognizes 3 main offenses relating to the money laundering. So in the sense of what the legislation recognizes as money laundering, it is laundering, failure to report, and tipping off. Laundering, failure to report, and tipping off. This is given by the legislation. Okay, moving on, we come to money laundering itself. So now we come to see what the phases of the money laundering are, how it goes about, First, let's see how much chapter is left. We have to do money laundering, and we have an example, and then we have implications of fraud, measures to detect fraud, and duties of the management, and bribery. Okay, yeah, that's about it. We're left with almost nothing. Okay, so there are 3 phases of a money laundering situation. So the first one is placement, which is the initial phase of money laundering. So what happens in placement? This refers to the placing of illegally obtained cash or assets into a legitimate business. The purchase of shares in a company with stolen money, right? So when you place of illegally obtained cash in the business, that is known as placement, which is the first phase of money laundering. The second phase after the placement is layering. Now, what is layering? Layering relates to the transfer of the money between businesses or locations in order to conceal their original source. So you need to hide the information from where you actually got the money. So concealing that source and doing all sorts of work which relates to that comes under layering. So wiring money between banks to make its original source harder to trace. Integration. Now, what is integration? Let's talk about that. Integration means after layering, the money now appears to have come from a legitimate source. So, after you've done the placement, after you've done the layering, then obviously the money looks like something which is legal in nature, or it has come from a legit source. So that is the last stage where everything appears to be normal to ground. So that is known as the integration phase. So the money laundering will be in three phases, which is the placement, layering, and integration. Placement is when you actually obtain the money in the first place, and layering is when you're transferring the money from one place to another, and integration is when everything looks normal. Sorry. For example, an individual might buy shares in a business using stolen cash. So, buying a business using the stolen cash is something which is related to the placement phase of money laundering. These shares can then be sold shortly after the money transferred back into another bank account owned by the launderer. So that is led to the layering. The cash now appears to come from a legitimate source, the sale of shares in a company. So now that it looks like it is a legit thing, so that is where the third phase, which is the integration, comes. In many countries, relevant companies are required by law to put in place controls and procedures to identify money laundering transactions. These relevant companies are usually those who deal with large volumes of cash or high value items, such as banks and bureau de change. So, what is bureau de change? That is a foreign exchange place. The controls and procedures required by law will often include identification of large and unusual transactions, scrutinizing of unusual patterns of transactions, taking steps to ensure all customers can be identified, creation of the role of MLRO, which is the Money Laundering Reporting Officer, an employee who will be responsible for oversight of an organization's money laundering activities and who employees can report any suspecting money laundering activities to. If I'm an employee in the company and I suspect that a sort of money laundering is being taking place, I can report it to the MLRO, who is the money laundering reporting officer. Undertaking appropriate customer due diligence. This involves for the organization acting to ensure that its customers are who they claim to be. So we need to check for the records of the customer before we make any sort of sales or purchases, right? For individuals, this would involve checking their personal identification, such as their passport or driving license. The government requires this due diligence to be undertaken as a minimum when establishing a new business relationship. The first time a customer is dealt with you, the first thing you need to do is to check their identity. When dealing with an occasional transaction of 15,000 euros or more. So, see, 15,000 euros or more means that the customer is buying of like a lot of, money. So that might be a bit suspectable. So you need to check their identity before when you sell something which is more than 15,000 euros. So this includes identifying linked transactions where individual transactions of 15,000 euros and more have been broken down into smaller transactions to avoid detection. When money laundering or the financing of terrorism is suspected, when the organization has doubts about the accuracy of the identification information it has previously found from the customer, when a customer's circumstances change. So these are all the ways in which a company or the organization can look about and prevent or detect the money laundering fraud. It is also important that a business has a defined reporting process for any suspected money laundering. So, employees reporting suspicious activity to the MLRO can investigate the situation further. If there are grounds for reasonable suspicion, the MLRO should report to the relevant authorities, right? So, in the UK, this would be the National Crime Agency. After the MLRO also knows and he wants to report it to a higher authority, then they can report it to the National Crime Authority. Sorry, National Crime Agency. In the UK, criminals were using high value €500 notes to launder money through some bureau de change. Dirty sterling cash obtained through criminal activities was being exchanged for large number of clean 500 notes. Police were alerted by one bank when a single bureau de change asked them for €4 million in €500 notes. This represented more than the 500 that was sold to holiday makers throughout the whole of the UK. Post office network of 12,500 branches. So then police were alerted, and so that is how the case money laundering cases are looked after. As a control after this after this activity, future money laundering activities using high value notes, the €500 note has been withdrawn from sale in the UK. A bank employee becomes suspicious of a customer who has made several large deposits of cash into their account. He is concerned that they may be laundering money. Whom should they report to? So, first of all, the employee is concerned they should first report to the money laundering reporting officer and they will check about it. The possible implications of fraud to the company. What are the implications of fraud to a company? There is a spectrum of implications of fraud from the immaterial to the critical: loss of shareholder confidence, loss of assets, financial difficulties, collapse of the company, fines by tax and other authorities. So these are what are the implications of fraud will be on a company. What happens when the fraud has been uncovered? When a material sum of money has been lost, companies will often look around for someone external to blame, regardless of the fact that it is the management who have failed in their responsibility to prevent the fraud from occurring. In particular, the external auditors are known to carry insurance against being sued, so they are often a first target to be sued for negligence by a company that has lost money through fraud. If the external auditors had given an audit opinion that the account showed a true and fair view of for the period while a material fraud was occurring, then there may be possibly a legal case for negligence that the company could bring against the auditors. So, if an employee has been caught red handed while attempting a fraud, many companies believe that instant dismissal is the best policy, hoping that the problem will then disappear. But in practice, the fraudulent employee is likely to get a new job and defraud his new employer. So, just by dismissing them, that will not solve the entire problem. Thus, it is the best for society if a defrauded company risks some adverse publicity by reporting the fraudulent employee to the police so that the employee can be punished by law, rather than reporting the same behavior again and again in the new job wherever he goes. Once a fraud has been identified, internal audit should be sent to the department to investigate the circumstances and to make recommendations to improve the controls in the area to deter future fraud. Internal audit should report their findings to the audit committee, who can monitor whether recommendations are swiftly made by the management. Now let's talk about how we measure and prevent and detect fraud. So, how do you measure and how do you detect and how do you prevent fraud from occurring? So, the principal strategy of any organization to prevent and detect fraud is to establish an effective internal control system. So, now when you think about it, the control environment, the risk assessment process, the information system, control activities, and monitoring of controls. So these are the measures by which a company can measure and it can detect fraud from happening. So the first step of any fraud prevention is therefore to ensure that each of the five components above is set up and working properly. So to begin with, the first thing is the control environment. What is the control environment? A formal organization structure assigns authority and responsibility throughout the company. So everything should be in a good manner. So the control environment is something which talks about the hierarchy and responsibility and authority of every person in the company. So that is the first thing which we need to check, that if it is in control or not. After the control environment, we go to the risk assessment process. Now, what is risk assessment process? Identifying how procedures can be circumvented with an intention to commit fraud. So risk assessment process is something where we we find out how a certain situation might happen in the future, or just anticipating what kind of risks the organization might face if the control systems are not good. So after the control environment, the second step is nothing but the risk assessment process. So what is the risk assessment process? The company employs IT experts who can advise. The company may employ IT experts who can advise on incorporating new technologies into the production process. Then we have the information system. Monthly management accounts can be submitted to senior management so that they can monitor the company's performance on a timely basis. So, information system is when information is being given regularly, so that it's being checked on a very regular note. After all this, we come to the control activities. What is the control activities? It is segregation of duties. So by segregating duties, then everybody is, having segregated duties, which means that no one person is doing the entire work just by himself. After this, we have the monitoring of controls. So what is monitoring of controls? Internal audit are charged with reviewing the effectiveness of internal controls throughout the business. So then we need to monitor the controls which have happened. So what are the measures to prevent and detect fraud? The first thing is control environment, and then we have risk assessment, and then we have information system, then we have control activities, and then we have monitoring of controls. Effective internal controls help to ensure that a company is not unnecessarily exposed to avoidable risks. Effective financial controls, including the maintenance of proper accounting records, are an important element of internal control. But the internal control system must go beyond financial controls to cover the control environment and culture of control established by the management. So, all the internal controls play a role in helping to manage the risks that are significant to the achievement of a company's objectives. Since a company's objectives and the environment within which it operates are constantly evolving, the risks it faces are continuously changing. An effective system of internal control therefore requires a regular evaluation of the risks to which the company is exposed. Since profits can be viewed in economic terms as the reward for successful risk taking, the objective of internal controls must be to manage the risk properly rather than just eliminating the risk properly. So test your understanding. I think the test your understanding 5, it can be done by yourself. Just think about it and try to do it by yourself. Moving on, we come to the duties of the management in preventing and detecting fraud. So how does the management prevent and detect fraud basically? So what are the duties of them? We are going to see that in this section. And after we do the duties of the management, we have to do what bribery is. So what is the duties of the board of directors? So the board of directors, what's their duty in order to prevent fraud? To maintain a sound system of internal control. So maintaining the internal control is something which is a responsibility of the directors of the company. They need to have a good internal control. They need to check that the organization has a good internal control. Now, what are the duties of the audit committee? So to monitor and review the internal control and risk. So when you have to do the risk assessment, or when you have to see, when you have to monitor and review the internal control, reviewing the internal control, that is something which is done by the auditing committee. The duties of the employees generally, including senior employees below the board level, will include fraud prevention and detection. So let's revise. What are the duties of the board of directors? The board of directors might see that they have to have a sound check on seeing that there is a proper sound system of internal control. The audit committee has to review the internal control, and it should monitor the risk as well. And the employees must not be a part of the fraud, and they must report if any fraud is happening, and they need to prevent fraud from happening. The Board of Directors is required by the UK Corporate Governance Code to maintain a sound system of internal control. At least annually, the board should conduct a review of the effectiveness of the internal control system and should report to shareholders that they have done so. A sound internal control system is the first line of defense in the prevention and detection of fraud. Generally, the directors are responsible for taking all reasonable steps which are necessary in order to prevent and detect the fraud. The audit committee is required by the UK. Okay, so who's really responsible if any fraud or such a situation occurs? It's always the directors who are responsible. I hope that's clear. The audit committee is required by the UK Corporate Governance Code to monitor and review the company's internal controls and risk management systems. This should ensure the continuing effectiveness of the controls in prevention and detecting fraud. The specific duties of employees are set out in the contract of employment and in what they are told to do by the supervisors, but there will always be an implied duty to act honestly and to report suspected or actual frauds encountered by two supervisors. Fraud prevention and detection is the responsibility of every employee in the company. It's not just the responsibility of the board of directors. A small company may have informal working arrangements and a few specific control policies and procedures. How can the director still ensure that fraudulent behavior is prevented and detected? So, if there is a small company, then it won't really have an audit department, but you can have stuff like checking of the everything or checking how the or rotating the jobs, and we can have various stuff in which it can kind of prevent the fraud. Bribery. Now everyone knows what bribery is and everyone knows what corruption is. Bribery means that if I want you to do something unethical and I'm ready to pay you 4 lakhs for that, so because you know that the price is a lot, so you will do the unethical thing for me, which means I am bribing you. What is corruption? Corruption is when everybody does something which is faulty in nature and everybody takes a cut of the profit. Bribery is now recognized to be one of the world's greatest challenges. For example, KPMG surveyed FTSE 100 companies in the August 2009 and found that two-thirds said that it was not possible to do business in some countries without being involved in bribery. Yet only 35% had stopped doing business there. The ethical position. Accountants need to be very careful when deciding whether to accept gifts, hospitality and inducement, especially if excessive, as these may be perceived to be bribes. From an ethical point of view, bribery can be viewed as a threat to objectivity and also compromises the fundamental principles of integrity and professional behavior. Now let's come to what the legal position is. Many countries have strict laws relating to bribery and corruption. For example, firms are allowed to provide hospitality. This could be in the form of providing tickets to sporting events, taking clients to dinner, or offering gifts to clients as a reflection of good relations. However, where hospitality may be a cover for bribing someone, the authorities would look at such things as the level of hospitality offered, the way in which it was being provided. The UK Bribery Act 2010. The UK Bribery Act 2010 creates the following offences: bribing a person to induce or reward them to perform a relevant function improperly, active bribery. Matlab, you want somebody to do the work in a bad way and you are bribing them to do so. That is something which is known as bribery, active bribery. Requesting, accepting, or receiving a bribe as a reward for performing a relevant function improperly. So, we are the one who are doing it improperly and we are taking the bribe from somebody. That is known as a passive bribery. So, active bribery is when I am telling you to do the work improperly and I am paying you. That is called as active bribery. And when you are the one who are accepting the rewards and doing the work improperly, you are doing passive bribery. Using a bribe to influence a foreign official to gain a business advantage. So, when you're influencing a foreign official to gain a business advantage, Failing to prevent bribery on behalf of a commercial organization. The UK Act is the UK Act is unusual in that a business can be guilty of an offence if an employee or associate commits an offence even if the management are not aware of. It prosecuted under the Act, then the company can invoke in its defence only that it had in place adequate procedures designed to prevent persons associated from undertaking such conduct. This emphasizes the importance of having a robust system of internal controls, a strong anti bribery culture, and an effective internal audit department. Okay, so now we come to test your understanding. Practice questions. Which of the following is not a necessary requirement of a fraud? A deliberate act, a collusion between two or more people, deception aiming to gain as a result of fraud. So the answer is B, because it is not necessary that there should be two people, even one person can do a fraud. Which of the following suggests an increased risk of fraud and error in the recording of an organization's transactions? Simple corporate structure, employees who take regular holidays, high staff morale, employee bonus based on the sales achieved. So the answer is D. Which of the following types of fraud is not carried out by a third party to the organization? Advance fee, Ponzi scheme, false billing, window dressing. So window dressing is something which only the internal members of the organization can do. It has nothing to do with the third parties. Why would the auditors be interested in examining large credit notes issued at the start of the financial year? This may suggest that the non-current assets are being stolen. This may suggest window dressing of sales. This may suggest that cash is being stolen. This may be suggest that the purchases are being misstated. So this would obviously mean that sales has been window dressed. Who is primarily responsible for the prevention and detection of fraud in an organization? Prevention and detection of fraud in an organization is something which is related to the entire board of directors. An internal control which is required by law can be excluded from implementation in a company if the expected costs of operating controls exceed the expected benefits. False. If a control is required by law, it must be implemented regardless of what the cost is. Which of the following controls would discourage a teaming and lading fraud from occurring in the payments received department? Two people should be present at opening of mail. Records are made when the mail regular rotations of duties, control account reconciliations must be made. So the answer is C. We need to keep changing the person who does the work so that any sort of that might be avoided. Which of the following would not be an offence under typical money laundering legislation? Not be an offence. Possessing stolen property, investing the proceeds of theft or cash, transferring the stolen goods. Okay, which would not be an offence? Theft of cash and other assets. So theft is something which is illegal. It would not fall under the heading of money laundering. See, possessing and stolen is money laundering. Investing the proceeds is money laundering. Transferring the stolen laundry, all this is related to the money laundering. Even the theft of cash is illegal in nature, but it is not a part of the money laundering. Layering refers to the transfer of money between businesses or locations in order to conceal their original source. That's true. So that's it. We're done with this chapter. I hope you understood this chapter. If you want to watch the other chapters or other chapters explanations, the link of the playlist is given in the description box below. Also check out the other playlist where I was solving the Kaplan exam kit solutions. So after doing the chapters, make sure that you do the exam kit as well in order to get good grades in your exam. The link of that playlist is also given in the description box below. Thank you.